Good morning, Luke, once more. Hello? Luke?
Morning, Coach Carter. How are you?
I'm fine. Coach Carter is okay. How is Botswana?
Botswana is fine, Coach. Yes.
Yeah, this place is a bit cold today. I don't know how your weather is.
I think it's the same because it's been raining insistently since last night. So I think it's just introducing the winter to us.
Okay.
Yeah.
I guess this time around to be very cold, huh?
That's the focus that we're getting from the weather people. But there is that saying that no one can predict the weather.
Yeah, and can patronize God.
Yeah.
So today we start with one of the many topics in advanced financial reporting, which is group accounts, governed by IFRS 10. Before that, we used to have what would actually call as IS 27. We used to have IS 27, not what we would call, but we actually used to have IS 27 that is to govern how to consolidate group financial statements.
Okay.
So before we go into the presentation, I thought that I should just pick some few important things from the IFRS 10 document. I'm always a firm believer that it is important we get the data from the source, from IS Plus, and getting it from textbooks where it's abridged. So first we need to understand what's the objective, what's the scope. Once we understand the objective and the scope of the standard, of any standard, then it becomes easier to operationalize the standard. So with this IFRS 10, what is the objective of it? Here is basically to establish principles for the presentation and preparations of the consolidated financial statements. We'll go into details to actually check when a company, even if it has more than 50% shares, may not be allowed to consolidate. But it is also possible for a company that has less than 50% shares to consolidate the financial statement. So actually look at all those areas. So how are these objectives supposed to be met? According to IFRS 10, it says one requires the entity that controls one or more other entities to present consolidated financial statements. Here, look, it is very careful, and we need to read standards in a similar way in which lawyers read their constitution. The way the words are crafted or stringed is very important in the overall understanding of these standards. Here, the key word is control. There's a difference between control and significant influence. If possibly a joint venture, you may just have significant influence. You do not have the control. So we are actually looking at control, meaning that we are ignoring the amount of shares that one may have. All we're interested in is the control. Is the control there? So you do a test control. So once you do this particular test to test on whether company X has control over this particular subsidiary. Second, it defines the principles of control and establishes control as the basis for consolidation. Sorry. Boy, I'm in class, I'll go. Okay. Sorry about that. So it defines the principles of control and establishes control as the basis for consolidation. So IFRS 10, it actually sits on only one assumption, that is control. So once we understand control, then it becomes easier. 3, sets out how to apply the principle of control to identify whether an investor controls an investee and therefore must consolidate the investee. 4, sets out the accounting requirements for the preparation of consolidated financial statements. This is where now we'll actually start looking at how, if a company has bought less than, maybe let me say, less than 100%, but above 50%, how are we supposed to control? How are we supposed to consolidate? So we'll be looking at things like NCI. I think that's one of the major components. We'll be looking at the NCI. How do we actually treat those, the third parties? How do we treat the post-acquisition profits? How do we treat acquisition profits? So there'll be all these other rules, and it's quite interesting. The moment you get to understand these rules, then it becomes easier for you to perform any complex consolidation question that you may actually face in the exam. E defines an investment entity and sets as an exception to consolidating particular subsidiaries of an investment entity. So there is basically the scope. You have this document, you just need to read in depth. Let me just check on control. So under control says, an investor, regardless of the nature of its involvement with an entity, shall determine whether it is a parent by assessing whether it controls the investee. Part 7, they go on to say, that an investor controls an investee if and only if the investor has all the following: power over the investee, exposure or rights to variable returns from its involvement with the investee to variable returns. C, the ability to use this power over the investee to affect the amount of the investor's returns. Now we can go to my presentation and just do this. We formally start looking at group accounts. You always find a question, whether it's on group cash flows or it's just generally governed by IFRS 10 or I7. I7 obviously be consolidated group cash flows. So there'll always be a question. So we need to make sure that, and this is why I always want to look at these topics at the onset of the program, and the reason is very easy, so that people get comfortable working on these particular questions, so that by the time the exams is about to reach, or at the time of writing an exam, you'll be extremely comfortable. We can start looking at these subsidiary topics such as financial analysis, standards and the like. But I think the most important thing is to first look at the most important topics when we still have time. So we go now into group accounts. First is to understand the basic principles. So the basic principles are that the parent company and the subsidiary company, they'll always be regarded as separate legal entities.
Okay.
And they are legal entities because you have a subsidiary company. Maybe this company is called maybe Boom Limited. Then you have another company that is maybe Lusaka Limited. This company then buys, say, 100% shares in Boom Limited. Boom Limited will not stop existing as Boom Limited. It will continue existing as Boom Limited, and Lusaka Limited will continue existing as such. All is being done is that Lusaka Limited has just bought shares in Boom Limited, but doesn't mean that Boom Limited as a company will stop existing as Boom Limited, because 100% of its shares have been bought or acquired by Lusaka Limited. They will still remain as separate legal entities. They are different human beings. I've always given an example of wife and husband. That is one perfect example of IFRS 10, but maybe one will argue that it's a joint venture because it's almost at equal footing. But really what it is that we will still remain as individuals, as separate entities.
Yes.
Will continue existing as separate entities. I think that's the first underlying principle about the IFRS 10, which looks at marriages. Secondly, is that the parent group limited, which is a one single entity, will be mandated to consolidate the financial accounts within that particular group. So also get the financial statements that have been prepared independently by the subsidiary undertaking and consolidate them. But there will be certain rules that will need to be looked at. For example, on the first part of the balance sheet, which looks at the assets, there will be a component of investments from the parent company. They will show that they have invested in this particular subsidiary. Maybe, let's say, 2,000 Pula. Also, the subsidiary will show under equity, will show their, for them to even be normal, because all they are going to show is basically share capital down there on the last half of the balance sheet, the share capital and other components of equity. But at consolidation, you will know that this investment we were showing in the parent company of, say, 2,000 Pula is connected to the other half of the balance sheet for the subsidiary entity. And you'll be able to start canceling these things out. So the second part is basically on control and ownership. Here it is not an issue of significant influence, it's basically on control. And the parent company will have 100% control in the subsidiary undertaking, even though the shares that have been bought are less than 100% and above 50%. It does not mean that because the parent company bought 60% of the shares in the subsidiary company, it shall have only 60% of the control. No, it does not work like that. It is not a joint venture. And this is why when we are looking at joint ventures, we are only focusing on significant influence rather than on control. So unfortunately, the way it works is that the guide rails of the quantum of shares that have been bought in percentage form, as long as more than 50%, the parent company shall have 100% control. Then you have the NCI ownership. I remember those good years, I think around 2007, 2006, when I had a school in Livingstone called Hard Knocks. And this school was manufacturing chartered accountants. I remember then under group accounts, or what we used to call IS-27, the NCI, what we're calling as NCI today, used to be called the minority interest. But you see, the world is changing and they are becoming very conscious on the terms to use. I think they felt that we are also bringing human rights in financial reporting, and that's what I think. They felt like it was very disrespectful to call those who have less shares, who have less than 50% shares, as minority shareholders. So they crafted a good term, which they are calling as non-controlling interest, which I think is even more insulting than calling them minority interest.
Yeah.
and they are using, so we have brought in all these human rights things, and even in these countries, like say for example Zambia, my ethnic extraction, we are under 2% of the population of this particular country, the Ila-speaking people. So maybe if someone says the Ilas are a minority, it's a minority language or tribe in Zambia, maybe one will feel, I think we're being insulted. Why should we be called minority? Then someone decides to say, no, instead of calling minority, because they have minority interest in the stake of this country, we shall say they have non-controlling, they are non-controlling interest, or they have non-controlling interest, which I think is even more insulting. But they believe that that was the right term to use now than using the minority shareholders or minority interest. So we are bringing human rights issues, look, even in the way we prepare financial statements.
Yeah.
So we look at substance over form. Even when we are actually preparing these financial statements, this consolidated, when we are consolidating financial statements, I think one major concept that we look at is substance over form. And that's how we call it, but otherwise in full is substance over legal form. That we focus more on the real accounting transactions that happened. And here we are saying that the substance over form is the concept that financial statements and accompanying disclosures of a business should reflect the underlying realities of accounting transactions. I think our focus is just the underlying realities of accounting transactions. And this is why we use this particular concept called substance over legal form when we are actually preparing and consolidating these financial statements. Just I thought of focusing or broadcasting or magnifying this particular concept because it's a very important concept. It's as important as the going concern concept, where we're saying the company shall continue being in existence for a foreseeable future. That we don't expect, we don't even plan of reducing production or closing any of the production units, or completely not existing as a company. So we are actually preparing these financial statements using the going concern assumption. So we assume that this company shall continue being in existence for a foreseeable future. Same with the substance over legal form, or we are actually saying that when we prepare these financial statements and do any other disclosures that are supposed to be done, they will reflect the realities of accounting transactions. Is it okay, Luke?
Yes, it's okay. I understand.
So we then now go to definitions before we start looking at computations. Those days, again, I still remember around 2007, the word parent wasn't so much there. Maybe, like I've said, that human rights have also penetrated into the preparation of financial statements. We used to call them holding company. It was a holding company. But I think what is coming in is this particular holding company has a parental role to make sure that the subsidiary company does the correct thing because it is actually controlling the subsidiary company. So even as parents, we do control our children so that they are actually in the right path of the expectations, or they are within the expectations of the society. So we guide them through step by step, we mentor them. And I think this is where the term comes as a parent company, because as a holding company, it's like you don't care. Yes, you're a holding company, but maybe you do not have certain influences on how the company must operate or must be governed. The fact that you are the one who controls the financial and operation direction of the company, then in that case, you are a parent. I think that's where the term comes from, and I have no problem with it.
Okay.
Then we have a subsidiary, which obviously, if you have a parent, a subsidiary should have been called a daughter or a son or a child. I don't know. But basically, a subsidiary is a child to the parent. That's what it is. But then they call it a subsidiary. This is an entity which is controlled by the parent company or another entity, which in this case is the parent. So a subsidiary company, in whichever way you look at it, is actually basically a child. And it needs to be guided on issues of governance because the parent has control over the financial and operation trajectory of the subsidiary company. In this case, would actually say the child.
Okay.
I did actually mention that IFRS 10 rests on one test: control, just basic control, and saying the key concept in determining whether or not an investment constitutes a subsidiary is that of control. But then we have to define control, which I've already defined from the explanation I was giving you. We need to define control, and we are saying this is the power to govern the financial and operating policies of an entity. So you're actually looking at the financial and operating trajectory of this particular company. It is under your control. If the company does not perform well, I think the blame should actually rest with the parent. So control has been defined, and it doesn't matter how you craft the sentence when you're talking about control. Look, but as long as you bring in financial and operating, just these two, and passing an exam, like I said, is the most easiest thing, especially these exams which the passing mark is 50%. Because I've always said that you don't need to go in there being in a position that you know everything. You don't need to go there. All you need to do is to be semi-illiterate in that particular course, a course that you're going to write, that exam that you're going to write. You only need to be 50% illiterate.
Okay.
Because then you get 50% and you pass.
Yes.
So that is what it is. So there are certain buzzwords. When you write, maybe there's a question on IFRS 10. So what are those buzzwords? If this particular question is a narrative based, you pick, you can even write on the exam paper, you pick what are those buzzwords that I should use, which will guide me to write within context. So there will be certain things like one, control. Then I'll break control into financial and operating. Then I know that because the parent company First, I'll have that as one of the buzzwords with its sub buzzwords. Then I'll go to parent. Then I'll look at the subsidiary. Then I'll look at the NCI. Then I'll go down now to under control. What are those things under financial and operating? How are these things done? Obviously, at policy level. So I know for sure that it is at policy level because we're coming in as shareholders. So as shareholders, we'll give the mandate of running the day-to-day affairs of the company to directors. So I'm bringing in the issues of corporate governance. So if you have control and I'm looking at financial and operating, at what level am I looking at them? It will be basically at the policy level. And this is where now we talk about policies. So once I have these keywords and I place them, these keywords, I just write them in a very isolated way or in a disorganized way. I put them on a paper. Then I know these are the ways, these are the buzzwords that I'm going to use to write or to respond to this particular question. I don't need to go in the exam to think to having sentences in full. No, what you need are buzzwords. So those keywords are the ones that you use. You can even write in Seshona or Siswana or Silozi or Sisoto. It doesn't matter.
Yes.
So then the second thing under control, because we know that the key thing is basically having you governing the financial and operating activities. But then it goes in to say, usually control is achieved by purchasing more than 50% of the company's equity share. Is usually. So what does it mean? It means that it's still possible governing the financial and operating policies of an entity even when you have less than 50% shares. Elon Musk he recently bought shares. He bought shares for is it Twitter?
For Twitter.
But those shares, when you look at the quantum of the shares that he bought in percentage form, it's just about 9.2%. Look. But guess what? He's the majority shareholder. So these other fragmented shareholders can decide to give Elon Musk, if it was a company, can decide to give Elon Musk the mandate to consolidate the financials. Because he's the majority shareholder and other shareholders, as much as does not have more than 50% shares, but he's the majority shareholder. And the other shareholders have agreed to give him the mandate to consolidate the financial statements within the group. So in short, IFRS 10 defines control and they tell us how to consolidate, and we'll see what they say on consolidation. What are they telling us on how to consolidate? At least control, we know from our own understanding that control is basically financial and operating, guiding, governing the financial and operating policies. And why we're bringing the policies component, which is very key, is that these are just shareholders. The parent company is a shareholder. It's not going to go or at operational level. No, it is at strategic level. And this is where the policies come in, because it is at strategic level where the policies will be actually developed or shaped.
Okay.
So we look at a scenario which is still possible where a company can have less than 50% shares yet has control over the financial and operating policies of the company. So we're saying a parent stroke subsidiary relationship can exist even where the parent owns less than 50% of the voting power of the subsidiary. Since the key to the relationship is control and power. Boy, I'll call you in class. Sorry. Other situations where control exists are when the investor, and we'll look at that. But we have already buttressed this particular point, look, where I said, please, even when you are actually responding to a narrative-based question on IFRS 10, do not only assume that a company that has control should always have more than 50% shares. It is true that usually those companies that have control shall have, usually they have more than 50% shares, but that is not the only thing that can actually happen. There are different possibilities, different scenarios that would actually make a company that has lower than 50% shares and still have control. So let's look at them. Okay. Here now, these are the situations where control exists when the investor can exercise the majority of the voting rights in the investing. I've given an example of Elon Musk. It is still fresh and the world they are talking about it because Elon Musk believes that Twitter as a company was actually losing it on the area of free speech or in the area of free speech. I hope Donald Trump would be brought back on Twitter. So what did he do? He decided to buy the majority shares, and those majority shares are ideal. It's just about 9.2%. But can exercise the majority of the voting rights in the investee. That's what it is. Secondly, is in a contractual agreement with others giving control, where the other shareholders, they decide and say, look, Toga, you'll be given the mandate to control the financial and operating policies of this particular company. So at that time, they have given you control. We remember even in the times of Robert Mugabe, at the time that he was getting or acquiring land, or not acquiring land, when he was repossessing the land from our white brothers and sisters, there was one person who had more control, yet he wasn't a cabinet minister, he wasn't anything. He was just part of those who were called war veterans. I don't know if you still remember him. His code name was Hitler.
Yes, I remember him. Chenjerai Hunji.
So when you look at Chenjerai Hunji, the Hitler, as Hitler, he had the control. Why? There was a contractual agreement with the Mugabe and many other veterans that you will be given the poster position as a poster boy to go and start grabbing land from the white farmers. So he had the control. We see it in most of these African countries or governments where people with less formal, or should I say, unknown formal positions, yet they have huge control over the governance of the country. And we saw it in South Africa, the Guptas. They were in a position to appoint, at least from what we know or the literature that we have read, they were in a position to appoint ministers of their choice. they would recommend. But that recommendation, whether it was a mandatory, that it was a must that it had to be done or not, we don't know. But what we know that whoever they recommended was actually given a job. So what do you expect? That there was a contractual arrangement that was giving the Guptas control. That contractual agreement, whether it was legal or illegal, or it was in the best interest of the country and its people or not, but at least there was an unwritten contractual agreement. Therefore, they had control because they were managing the governance of the country.
Okay.
Then even when you look at Zim, in the last days of Robert Mugabe, one would even say the Gucci lady had control over the governance of the country.
Yeah.
Grace.
Yeah. Yes.
So she had the control.
Yeah, you can say that again.
Whether it was a bedroom contractual agreement, or she took advantage of the old man, we don't know, but she had control over the governance of the country. I'm sure even some of the ministers who were appointed in the Mugabe cabinet in his last years to power, some of them, one will not be surprised to find that Gucci had an influence over those people.
Yes.
If you hold less than 50% of the voting rights, but the remainder are widely distributed, like we are giving an example of Elon Musk, has only about 9.2 or 9.1% of the shareholding of Twitter. But those that have made 1%, 0.1%, they are so fragmented that they cannot also come together. They are widely distributed that it is practically impossible to bring them together so that you form one voting bloc. Elon Musk will still have a voice, and this is why now he's going to be sitting on the Twitter board. Why? This basically shows you that the rest of the shareholders are widely distributed. Their shareholding is widely distributed. That is very difficult to galvanize it together and have a leader within that who would actually sit on that particular board. Does it make sense?
Yeah, it does. Makes a lot of sense.
Or one holds potential voting rights, which will give control. Would you give an example still on Elon Musk?
Like
Yeah, you can continue. Look,
I think that similar to the proxy that you can get, like a proxy vote.
Like a proxy vote, they say, no, you're going to actually vote on our behalf and whatever and whatever. So then at that point, you have the potential voting rights. So we then go to the subsidiary. We have agreed in principle that IFRS 10, it does actually look at the parent company, and that company which is being acquired, whose shares are being acquired as a subsidiary company, or softly as a son or daughter. So we have actually said that a subsidiary is an entity that is controlled by another entity. In this case, a subsidiary is an entity that is controlled, is a child that is controlled by the parent. And this parent, even when he's controlling the child, is only looking at or focusing on financial and operating trajectory of the company through the policies that are shaped, governed, that are shaped and approved by the parent company. So an entity has control of another entity when it has the power to direct the activities. Here we have to be very specific. We are looking at financial and the operating. So the parent company must prepare a consolidated financial statement. It has control over one or more subsidiaries. And we have given the examples, live examples of when a company will be in a position to prepare or to consolidate the financial statements. But it rests on the two underlying principles. And these are the buzzwords that you have to use if there's a narrative-based question on IFRS 10. Is substance over legal form, which we have explained and we have defined substance over legal form. That first our focus will be on the accounting transactions. So the legitimacy of those accounting transactions, that is what we are going to focus on. Secondly, it is control and ownership. And we were very gracious in defining what control is. And under control, we just brought in two things, actually three things. We brought in financial, operating, and the policies. And we explained why we are looking at policies at this level, because the parent company will not come in there to start doing the actual work. It will be a strategic level, and at strategic level, they focus on policies. So we then now go into the mechanics of consolidations. The basic steps. So on this one, first, we need to, do I have something to write? Let me just check if I can write something here. So we know that we have two players in this case. We have the parent company and we have the subsidiary company. This is a vanishing pen. Sorry. I got something that is just vanishing. Sorry. Long since I used these features, so. So we have the parent company, and we have the, yeah, it's vanishing. It's long since I used it. Okay. But let me just explain it anyway.
All right.
Okay, so we have the parent company and we have the subsidiary company. So with the parent company, it will buy the shares from the subsidiary company. So the only part in the balance sheet where it is going to show that will be on the assets.
Okay.
Under the assets, sorry. But under these assets, it will show as investment. It will come in as investment.
Okay.
Under non-current assets. So they will show that they have actually invested, for example, 2,000 rands. But for the subsidiary company, which is actually being acquired, you expect a component under the subsidiary to not be the first half of the balance sheet. It will be the second half or the last half of the balance sheet. So in the subsidiary, we expect that it will be shown under equity.
Okay.
So the share capital will remain as is. Under the component under equity. So we'll show there under the post whatever, under the share capital there, under equity, you will show that there is more equity that has come in, because basically it's so about equity. There's equity that has come in, which is 2,000.
Okay.
But then at consolidation, it is believed that these two companies, they shall now become one at consolidation. So any intra transactions shall be cancelled. That's the underlying concept. I've always given this example of the husband and the wife. If you go to my mulamu and ask her for maybe a 200 puller, you say, please lend me a 200 puller. She gives you that 200 puller. The money that you have, for example, and what she has, she's not going to count that 200 puller. Because we need first to cancel that. That is not part, it's not that transaction is not going to increase or decrease the family wealth.
Yes.
So at that point, we'll need to cancel it. So the first thing that we do is to cancel the investment and what is under the investment under the parent company and the earnings, and equity under the subsidiary. Those have to be cancelled, and that's when we can consolidate. So you're saying 100% P share capital and share premium only. So you are picking, and I've seen students, even those days I used to mark these exams, I've seen students where they add the share capital of the parent company and the subsidiary company have the total. It's not possible because the subsidiary is a product of the parent company.
Mm-hmm.
And because what you have done, you have canceled the investment on top from the parent company and the equity down from the subsidiary company, meaning those things have been canceled. So there is no need to start adding. The parent company will not increase its shareholdings by adding what is coming from the subsidiary company. No, the interest has already been done through investments on top.
Investment, yeah.
Then we have the retained earnings, which is basically the balancing figure. Here we know that under retained earnings, it will also come into two components. You have the retained earnings before you acquired or you bought shares in the subsidiary company as the parent undertaking. Secondly, there will also be retained earnings that have been created through your governance, through your control, which we are going to call post-acquired retained earnings. And the treatment is different.
Okay.
So we have this basic example. Says Namakau acquired 100% of the equity share capital of Sakuwaha on 31st December 2018 for 1 million kwacha. The financial statements of the two companies at that date were as follows. So from here under the subsidiary or the parent company, the only evidence we have that the parent company invested or bought shares in another company, whichever company it is basically here.
Mm-hmm.
At least in the financial statement, it does show that this investment is coming from Sakuwaha or was acquired. We invested in Sakuwaha. So if it is 100% shares, then we know that the only part of the balance sheet for the subsidiary company where we're actually going to find our ownership, because then it means that we have ownership in this company as a parent company. You have ownership in this company.
Mm-hmm.
So the only part which shows ownership is this particular part here. So if it is 100%, meaning that this is what you have at acquisition. So you acquired the value, you acquired the share capital, even the retained earnings which were there, they were acquired by yourself.
Mm-hmm.
And we did mention that what is down here reflects what is up there. It's what is applied. So you have that 100, that 1,000, that 1,000 plus the 200, which is coming from liabilities. That is what you use to grow your asset base, which is this. But try one. I've kept on trying. I'll keep on trying. You know, class to Milan. Hello? I'll call you.
Okay.
Mm-hmm. You remember last time we did actually mention that we have, when you're looking at the balance sheet, look at it in two ways. That you have the eyes, which is this first part, and the ears. So whatever you have here should be applied to acquire what people are able to see.
Yeah.
So in this case, when you're doing your consolidation, meaning that you cancel this and you cancel that.
Mm-hmm.
Mm-hmm. That is what you cancel, then it consolidates.
Okay.
Mm-hmm. Okay. Is the concept clear?
Yes, it is very much clear. Thank you.
Okay, thank you.
Yeah.
So what I want you to do, then I'll do it with you after you've done. You tell me how you've done this. I want you to work on this question.
Okay.
I'll give you about 5 minutes, just 5 minutes. Let me even just switch off everything from my side.
Okay.
Okay, let me know how it was done. Just explain, then we'll do it together.
Okay. First of all, like I said, I cancelled out the intra transactions, which is the investment in Sakua, the 1,000, and also cancel it with the 250 plus 750. So there is a 150 remaining there under retained earnings, which we need to add. So after doing that, so my total assets on the consolidated column would be the 1.9 plus the 1.4, and then we adjust for the 1,000 that was invested in Sakua, which I assumed was used to acquire those assets, which are now for the subsidiary, which are 1.4. So I would have 2.350 for the assets, other assets.
Okay, so in short, what we did here, you added these two. So when we are actually looking at the consolidated, so let me just put here as consolidated. I'll just say console. So it's 19 plus 1,450. How much did you get?
I got 3,350.
So 3,350.
Yes.
Which certainly would be the asset value. Then on the share capital, we have 1,000, right? Because you're only picking this, which is basically 100%.
Yes.
For the parent company. Then here we have 1,400. We have 1,400 times, or plus, sorry. Then we have the difference, which is 150.
Yes.
Times the shareholding, which is 100% in this case.
Yes.
If, say, for example, we had 80%, we are going to only get the 80%. Then the 20% would have actually gone to the NCI. So we have that, which you got is 1,550, right?
Yeah.
Which gives us how much? Which is 2,550.
Yeah.
Plus the liabilities, which is 800. Which should actually give us, unless otherwise, 3,350.
58.
Okay. Thank you. So we then now go to another component under the non-controlling interest. So the non-controlling interests, like we said, they are basically the minority interest shareholders. This time around, according to IS plus, they are called NCIs. So we're saying these NCIs, they have less than 50% interest in the parent company.
Okay.
So we know what the NCI, how they actually come about, because if you haven't bought as a parent company, you haven't bought all the shares, the component that actually remains will be attributable to the minority shareholders. So the organization owns a part of the subsidiary. These are things that we have actually said. The joint partnership agreement details the official relationship between the two or more organizations that own the subsidiary. So whenever you own a subsidiary, you have to draft or come up with your joint partnership agreement that stipulates all the things in there, who is going to be consolidating the financials. The decision of who is going to be consolidating the financials entirely comes from the joint partnership agreement.
Mm-hmm.
So we have explained what the NCI is. Like we said, that it doesn't matter what the parent company holds, as long as more than 50% qualifies that company to be a parent company and is going to control the financial and operating a trajectory of the company 100%. That we agreed. But then it is also necessary that we should be able to account the component of the minority shareholders. I'll ask you this question, look. I know it's not documented anywhere, and my answer is not based on documentation or be based on principle and logic. Why do you think the NCI sits between the equity share capital and the liabilities? I'm sure you have seen how their format is.
Yes.
Right. So based on the international accounting, whatever, you find that you have your equity and capital and equity, where you have the share capital, you have the retained earnings and all these other things. Then you close it. Then in between, you have the NCI. Then you have the liabilities. What's the logic behind that? What do you think?
Aren't they recognizing that it's sort of a contingency number that they maybe, for lack of a better word, maybe contingent liability that you've already sort of asserted.
Yeah. So from my thinking is that the non-controlling interests or the NCI shareholders, they have invested in equity. Like I told you that you have investors who invest in any of the two or both, who either invest in equity or debt or both, a hybrid. So out of courtesy, the preparers of these consolidated financial statements, who in this case are the parent companies or whichever company has control, it does recognize, based on protocol, that the NCI has few equity shareholders. But because they are not part of us, they should come in just after us showing the shareholding, after us, but before the third parties or external investors who are investing in debt. So you recognize that yes, as parent company, us who have invested in equity, but there's also this small section of people who have also invested in equity. So they should come next to us. So all you're doing is that you're grouping equity investors before you actually look at the debt investors. That's just my thinking why minority shareholding sits between the owners, those that have control, or the parent company ownership, and the debt investors. I don't know if it makes sense.
Yeah, it makes sense. It makes sense.
Because in whichever way you want to see it, look, they are still equity investors. They are equity investors. It's just that you are not getting a component. So you're saying from this particular, if we are looking at project financing that we do mostly when I'm modeling these big financial transactions, we normally look at, okay, who are the equity investors? So you find that because it's a project finance thing, you have equity investment maybe of, say, for example, 15%. The 85% comes in as debt under project financing, but that 85% debt will also segment it. We'll start with the senior lenders. From the senior lenders, we'll go to the subordinated debt. So you start with the senior debt, you go to the subordinated debt. Under the subordinated debt, you can still group it with, maybe you have mezzanine. So you can bring in mezzanine or frontier, whatever it is. So you are listing that under the debt investors, there is the senior debt. And usually the senior debt is much cheaper than the mezzanine debt, than the junior debt. So you list those things. And I think even when they are coming up with the formats, they looked at it. We cannot have minority shareholder, for example, after liabilities, because in any case, this minority shareholder has equity interest in this particular company. The only thing is that it hasn't bought enough shares to sit on the first table. But to sit on the high table, they call them high tables, to sit on the high table. But to sit right after the big boys. May have access to chilling with the big boys, but to sit behind the big boys.
Yeah.
So that is how I've always looked at this. So the non-controlling interest is measured using either of the following methods: proportionate share of net assets or fair value. Let me just explain this concept. So the proportionate share of net assets, your net assets, as we start looking at these things tomorrow nicely, then your net assets is this component here. This is your net assets. You ignore everything. So this is your net assets. So if it's proportional of net assets, oh, sorry, let me do this. So proportionate of net assets, it means that for the NCI, if say the NCI is on 5%, so you have 150 times 20%. That will be for the NCI. Under the NCI here, it doesn't matter. It doesn't matter whether it's post or pre-acquisition, because all you're doing is that you're saying we're not going to spend more time to start segmenting what comes as pre and post on the NCI. We are just going to group it and say, this is the value of the minority shareholders.
Okay.
But from your side, you'll be able here on the component under retained earnings, you're able to, what was acquired before acquisition or the retained earnings before acquisition is part of your computations in your goodwill, because whatever retained earnings were there at the point of acquisition was part of the deal. You did not just buy equity shares up there. You bought the value of the company. So you bought the net assets. So in that net assets, unfortunately, there's a component of retained earnings, which these are profits, accumulated profits, and possibly losses for over the years, but before you had control. So you cannot get a portion and start putting it as retained earnings. No. Anything at the point of acquisition, everything that was there, you actually bought. So you don't go to a company and say, no, me, I'm just buying these shares. No, no, no. Your interest as a person who's acquiring this company, your interest is in the net assets. So all in all, on the net assets, what you're buying, you're not interested in the equity share capital, the retained earnings. No. What you are buying logically are the assets less liabilities. So you go into a company, or if, say you want to buy a company in Zambia, you travel from Botswana and say, I'm buying this company. The interest that you will have is in what are the asset values of this particular company. That is, we are using asset-based type of acquisition. What's the asset base of this company? They tell you, the asset base of this company is 200 million kwacha. Then you ask, how much are the liabilities? No, the liabilities is 20 million kwacha. So you say, for me, I'm interested in, so the value of this company will be 180 million kwacha. Because if I use the 200 by, then I need to get the 20 million, give it to you guys, and pay whatever you have to pay. But I'm not going to pay 200 million kwacha because I wasn't there when you're acquiring these liabilities. So for me, as I'm buying this company, I'm only looking at it. I'm not going to get your encumbrances, which come in because of your liabilities. No. So I'm looking at the net assets. And that is what you're buying. But apparently that net asset is basically the equity share capital and retained earnings, or anything that sits under capital and equity. It could be share premium, could be anything, as long as it sits under share, whatever.
Definitely, yes.
So,
yes, I do.
Any profits at acquisition will be part of your purchase deal. Those who actually go and sit, they'll actually sit under the goodwill computation. And this is why they sit under goodwill computation when you are computing goodwill. Okay.
Okay.
Is it understood? Because Coach Carter wants to make it more practical, very basic. Yes, look.
Okay, you said it sits under goodwill. I mean, can repeat.
Well, yeah.
You can repeat the last part. You're saying it.
Hello.
Are you saying that it will sit under goodwill?
So it will be a product of your goodwill computation, or it will be, sorry, not a product, it will be an input of your goodwill computation. Because again, the concept of goodwill, what do they call goodwill? What they call goodwill is basically what I would call, you have been, that 419 by the Nigerians, you have been scammed. Goodwill, in short, is being scammed. The principle of goodwill. where you find that the company value at the time of acquisition, the company value is 150. You get that, huh? It's 150. Then this person where you're buying this particular company says that no, look, you are actually buying it at 1,200. Yet when you look at the asset value of this, the net assets is 150. In this 150, like I said, there's the share capital and the retained earnings up to the point at which you were acquiring this particular company. So you, to make yourself feel that you haven't been scammed, you say, what I'm buying, the value of this company, yes, is 150, but I'm buying it at 1,250. You are not going to call it scamming. This 50, you're going to call it goodwill. But in short, this is basically your stupidity. You failed to buy it at 150. So at some levels of comfort, it's a feel good thing of saying that this is goodwill. Because you have acquired this company over and above the net assets. And then now you're going to justify it. No, this 50 that you are seeing here, it is because this particular office or our offices are next to the hospital. UTH, for example, if it was in Zambia, are next to UTH. And because they're next to the UTH, there is no load shedding. So whenever the company is going, whenever the country is going through huge power deficits and they are doing load management, will not be load shed. Because the line is connected to the hospital. You start coming up with all these silly examples or reasons to justify why you bought this particular company at over and above its net assets. You call it goodwill. But in short, that one who has sold you this particular thing has scammed you, says, we have scammed these guys. I put it at beyond the value of this company. So you say, no, it's because of the place, it's because of this and this, it's because of the value, the brand value of the company that we are buying. Since we are not just buying assets, we are buying customers, we are buying the good name of this company, blah, 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 blah. And you just fight and you call it goodwill. So this is what I was saying. The pre-acquired profits are part of your goodwill computations based on what I'm explaining, what I've just explained to you. Does it make sense?
Yes. Yeah, it does.
So that is on the proportionate. I've explained what is proportionate. On fair value. On fair value, yes, the company's net assets, physical net assets, which is basically your assets less your liabilities, is say 1,150. But then, after doing a fair value assessment, which could be through revaluation or whatever, doing a fair value assessment, which is closer to the market, it is found that this particular firm is, say, 1,300. So what you do, you ignore, as long as in the question, they have given you fair value and you have the net asset value, you ignore the net assets and you pick the fair value and use now to calculate your NCI and for the group. And for the group. So this number, if it was in the constitution, we'll say it takes precedence over this number. So as long as in the question, you see where the examiner has highlighted or has broadcasted a fair value amount, it is wise that you pick the fair value amount to compute your goodwill also to compute your NCI.
Okay.
Is it okay?
Yeah, it's okay.
Now, having explained that, let's read this question. I don't want you to do it, but I'll give you some hints anyway. It says, Piri acquired 80% of Sangwa's equity share capital on 31st December 2017, when Sangwa's retained earnings were 750,000 kwacha. The financial statements of the two companies at the end of 31st December 2018 were as follows. So I've been given the balance sheet. Then down there, we are told, prepare the consolidated statement of financial position for the period group at 31st December 2018, assuming the non-controlling interest is measured using the proportionate share of net assets. This. So we know for sure that the retained earnings, it was 750 and it went up to 900. So meaning, if we are calculating for the retained earnings, you need to do your percentages, your proportionate percentages. So I give you about 7 minutes to deal with this question. Then we'll do a review.
Okay. All right, that's fine. Right.
Okay, let's do it. We can do it together. So this goes.
Yes.
So meaning that we'll have on other assets, we'll have the same amount. How much was it? 3? Is it 3,350?
Before, yes, it was 3,350.
Yeah.
But in this case,
because it's 19 plus 1450.
Yeah, it will be 3,350.
Okay. So this is what will come here as well.
Okay.
Then on equity share capital, we'll have 1,000. On the retained earnings, we'll have 1,200. Let me just write it somewhere here. Plus 150. Times
80%.
Times 80%.
Yeah.
It will give you how much?
It will give you 120.
So it's the 120 plus 1,200, which is 1,320. Is it?
Yes. Yes, 1,320.
Which then gives us
2,320.
Then you have the NCI before the liabilities. Of that, you have the NCI. So on the NCI, remember that since you are picking from here, you have the 1,150 times the 1,150. You have the 1,150 times 20%. How much do you get?
1,150. You get 230.
230. Then you have the 800 down here.
Yes.
So when you add the 2320 plus 230 plus 800, how much do you get?
You get 3350.
That is how you balance it.
Okay. I think I was doing it the long way. For me to get the 230, what I did is I took the 750 and then got a proportion for the NCI there, which was and then got the retained earnings, which is the difference, which is 400. So if you add the two, you get 230.
Okay. Because all you're saying, remember what I said, that it doesn't matter whether it's pre or post for the NCI. All you're trying to do, you as a preparer of these financial statements, you're looking at this net asset, and they're saying from this net asset, there's 80% which belongs to us as the parent company, and the 20% which belongs to these other people we are calling as NCI. So let's calculate that 20% and plug it in.
All right, that's fine. So I think the key principle that I was missing was that it doesn't matter whether it's pre or post. That's why I went the long way of looking at the pre and then the post and then calculate, although I came with the same figure, but I think I'd missed the basics there.
So it's basically just these basics. The moment you understand them, then we will not have problems as we go forward. Yeah. So how is it? How is it now? How is it now?
No,
how's the lesson?
Very much. The lesson was fine, enlightening, and I think I get the basics. Yeah, I do.